This episode of From Angel to Exit is brought to you by Dash. Dash offers remote knowledge workers to streamline workflows for U.S. businesses. Services include CRM management, email organization, social media content, bookkeeping, research, lead generation, and more. Dash professionals save clients time by managing routine tasks, allowing businesses to focus on growth and other high-value activities. For more information, visit hirewithdash.com. Now, on with our episode. Are you serious about planning a successful business exit? From Angel to Exit is your go-to resource. Subscribe to our newsletter at eckfeldt.com/podcast for even more valuable insights. And to get personalized guidance, take our free exit readiness assessment. It's just 24 questions, and it will give you a clear picture of your exit readiness. Find the assessment at eckfeldt.com/exit. Submit your results, and we'll schedule a free follow-up call to discuss your specific situation and the best way to maximize your valuation and ensure a successful transaction. Now, back to the episode. Welcome, everyone. This is From Angel to Exit. I'm Bruce Eckfeldt. I'm your host. Our guest today, Bill Snow. He is Managing Director at Focus Investment Banking. He has a lot of experience in the M&A world. He's also a visitor speaker. He has written several books. I'm sure we'll talk about some of those. And really a lot of insights on what the whole process looks like for companies looking to exit, all the different types of exits, the things you need to do to get exits right, some of the trials and tribulations that companies go through. Excited for this. Bill has a lot of experience and a lot of insight, so I'm excited to hear what he has to say. So with all that, Bill, welcome to the program.
Bruce, thank you. Appreciate it.
Yeah, no, it's a pleasure having you on. Before we dig into everything you're doing today and Focus Investments and the books and everything, I'd love to get a little background, like professionally, like how did you get into this space? What kind of got you into the whole M&A world? Give us the story.
I became an investment banker because I couldn't do anything else. I think that was the... or maybe I lost a bet and had to do this kind of work here.
Exactly.
So when I finished college, I didn't know what I wanted to do, and so I kind of floundered around for a while. So I had sales jobs and worked for theater companies selling tickets, group tickets, things like that. Worked for a retailer in a management role where we were acquiring kind of mom and pop stores. I was living in Georgia at the time,
okay,
and I was overseeing operation of those stores. And I became interested in, well, how do businesses start? What's that whole process? And so I very wisely or very stupidly decided to work for friends and family funded company, and then I went up the food chain and worked for an angel funded company, and then eventually a venture capital funded company. So I learned that game, that financing game, and the venture capital funded company went the way of the dodo, and a few years later I was contacted by a former colleague of mine who I stayed in touch with, and he went to work for a middle market investment banking firm, and they were looking for someone who could make phone calls and read a balance sheet, talk to people. They couldn't find him, so they called me. And I turned down the position, I think, 4 or 5 times before they caught me in a moment of weakness. And I decided, okay, fine, I'll go be an investment banker. So everybody thinks like it's this big, incredible thing. You know, it's being active, it's learning, it's knowing a lot of people. And, those opportunities sometimes come along. And you have to be open in terms of your career to those opportunities. Everybody wants to be an investment banker for some reason, and maybe some will make it, but there could be some other very viable career paths that you stumble upon that end up being a good thing. So I've been doing this for close to 20 years now, and I used to be a lot more intelligent before I became an investment banker, but I'm hanging in there.
What are the costs of the profession? Actually clarify for me, because I think people get really confused. Like when we talk about investment bankers, right? Like there's really nothing to do with a bank and not much to do with investment. Like what does an investment banker do?
That's what I say. We do nothing with investments, and we're not a bank, so we call ourselves investment bankers. It's just a fancy term so we feel good about ourselves because we're not an official profession like legal or accounting or architecture, medicine, things like that. So investment banking, there's all kinds of flavors of it, all kinds of creatures who do this kind of crazy work. It's essentially working with a company that wants to do something in terms of the ownership.
Okay.
Raising money. So going public is one of those main things I don't do. I don't work with public companies. I don't list shares. That's obviously a very viable business. Everybody thinks of that.
Yep.
In that case, you've got to have retail investors that can buy those shares that you are going to list for the company. I do middle market, lower middle market, so that's roughly companies $10 million in revenue up to $300 million.
Okay.
Typically like to see at least $1 million in earnings, EBITDA, but probably about $2 million these days I think is going to be more viable. And so we will do what? We will sell those companies, sell part of them, sell all of them, sell off a division, a unit that the business might not want. Certain situations will raise capital. That's really brain damage work. You don't want to do that. That's bad. Everybody has a nephew that has an app and needs $250,000 and thinks they can hire someone like me to raise. It's not going to happen. Nobody wants that kind of stuff. It's terrible. Go do something else. Yeah. And we'll help make acquisitions too. And that's brain damage work. So I do that. I really enjoy that. I've got some great clients, but it is trying to buy a company might be one of the most difficult things that you can do in business. Don't do it. Don't go do something.
If you can
else.
Avoid it.
Yeah.
So you mentioned a couple of terms in there. I would love to kind of just get your kind of definitions or at least insight on. So middle market, lower middle market. Like how do you kind of divide up the world of companies? You're mentioning EBITDA and kind of ranges. Like what are the categories or what are the breakpoints for you in terms of the size of the companies or types of deals?
Sure. Well, the main thing when we look for clients, we look for a really difficult, challenging type of client to find, and I think they're called anybody who will hire us is basically what we're looking for. And most this is the dirty secret. Most investment bankers will do that because we're consultants. I mean, we want to get paid. We do good work. We deserve to be paid, of course, but it's tough to find clients. So I define middle market, and everybody has their own variations, as roughly 10 million in revenue to 300 million. Maybe that's lower middle market. I used to work for a firm. They didn't like the word lower. They thought that would be insulting. So it's middle market. So it really depends. I guess probably other people might say middle market's up to $1 billion in revenue. Okay. But these are going to be closely held businesses owned by a founder or maybe a family or maybe a couple, 2, 3, 4 entrepreneurs, whatever. And it's privately held. These are not listed companies, and they're doing 20, 30, 40, 60, 80 million a year in revenue. That's kind of the sweet spot where I typically work.
Okay. And how do you differentiate between kind of privately held versus companies that may be VC backed or already have some kind of cap table or set of investors? Like, is that a different beast for you, or how do you kind of divide up the ownership structure?
Not really. I mean, I've worked for companies, private equity firms selling things, and it's the same thing. So whether you're an entrepreneur, a company's owned by an entrepreneur, one person, or it's owned by a private equity firm, that company still has shares that have been issued and registered, and it's just a matter of who owns it. So it doesn't really make that much of a difference. Okay. And there's pluses and minuses. Sometimes the entrepreneurs are a little more shoot from the hip, which can be good and can be bad. Sometimes the PE firms are more methodical, which can be good, and sometimes that slows things down. So there's pluses and minuses to both ownerships.
Yeah. In terms of types of deals, like how do you kind of categorize when a company comes to you and they're looking to sell, and the possible different types of exits?
What's that? A company comes to us and wants to sell. Where are these companies? How can I find them?
Yeah, exactly.
Oh my goodness, that would be wonderful, Bruce. Well, you have to send me a link afterwards.
No, I've got a secret link. I'll send you.
It is one of the most difficult things to do is to buy a company.
Yeah.
And because everybody wants to buy. You can walk around, I'm in Chicago, you can walk around downtown Chicago, and within 5 minutes, just randomly asking people, assuming you don't get mugged or something, you still have your watch after 5 minutes, you randomly ask people during the daytime, not during the nighttime where they block off the streets and they drive their cars in circles and smoke marijuana and do all that kind of stuff. But during the day, when the business people are down there, if you ask somebody, would you like to buy my company, or do you know anybody who buys companies? Odds are you're going to bump into either a CFO or somebody who works for the CFO or somebody who works adjacent to the CFO. Somebody who's going to know somebody very quickly. So it's very easy to find a buyer. So I say finding a buyer is easy.
Okay.
Getting a deal done that makes sense for the seller, that's difficult. Finding a buyer easy. Getting a deal done that makes sense,
and why?
That's really difficult.
Like why is it hard to make a deal actually happen?
Well, because everybody wants to look, okay? And so
Everyone loves to shop. No one likes to buy.
Yeah. Because why not? If someone wants to give you a free look at a business, why not take a look at it, right?
Yeah.
Even if you're interested or not interested, and maybe we're not that interested. You take a look, and hey, this is
test
a good
driving
thing.
a car. It's like,
of course,
I'll test drive any car.
Yeah, exactly. When you're a buyer, when you want to make acquisitions, why not cast a wide net? If somebody wants to show you stuff, people contact me, investment bankers who don't do their job, which is a lot of them, which is most of them probably, and they think that I'm an executive in a company instead of just an investment banking creature. And so they'll send me a teaser, and I'll sign the NDA to take a look. Sure, why not? If they're reaching out to me, why not learn? So finding a buyer is easy. Everybody wants to look. Finding that right thing where you can actually get the transaction done, that's what's really difficult. And a lot of buyers make the mistake that they think it's like going to a grocery store. Okay, well, we're out of bread and apples and milk. We'll go to the store and buy that. If you're out of that stuff, you go to the store and get what you need. We need a company. Let's go to the M&A store and buy a company because we get contacted all the time. Show me your listings. No, I'm not going to do that.
Yeah.
Make sure that I can find you. If your criteria, your investment criteria matches a company that I'm selling, then by all means, we will reach out to you and contact you. But it is so hard because you have one company for sale, multiple buyers, okay? You can't, if you're in a frothy market and multiple bidders are interested in that asset, you can't duplicate it. You can't run a second shift and crank out more of that company. It is a very limited resource. And so that's why if you have a good asset, you'll have you tend to have a pretty strong bidding these days, and even with the higher interest rates, because it is just so hard to find a good company that is willing to sell.
Yeah. Well, and so you mentioned this, the investment model, or if what you're looking for fits the asset that I have, the asset that I'm representing, like what goes into that? Like how do you kind of break down what the company is looking for to decide if it's a fit? Like what are the variables?
Sure. So anybody who wants to buy a company, please take this note. And I tell this all the time when I'm contacted by private equity creatures. And I tell them they want to get on our list. They want to see our list. And what I tell them is what we use is something called Capital IQ. Okay. And maybe pitch book, but I've always used Capital IQ. The younger kids, the hipsters, they like the pitch book, I guess, because it has a cooler name. But what we do is we use these expensive databases. You have to subscribe. People like me have to pay, or my firm has to pay. But it's invaluable because I've made a very good career using Capital IQ. So we'll put all the criteria in terms of a company when we're looking for buyers, whether it's a strategic, private equity, doesn't matter, geography, revenue size, type of business. I mean, it gets very granular. And so I always tell the private equity people, if you want to get looks from my firm and firms like us, make sure your information is up to date in Capital IQ, the investments you have, because what we like to see when we're selling a company is a strategic company that's owned by a private equity firm, because we know, hey, there could be a really good strategic fit, and we have a private equity firm that not only has money, but these are deal pros. And so these are people who we might be on opposite sides of the transaction, of course, but they're professionals, and I like to negotiate with people like that because they know how to run a process and what is to be expected. So make sure you do that. Make sure that where it's easy to find you, all right? Make sure that we can find your email address, your telephone number. If you're a privately held business, not a private equity firm, a strategic firm, and you want looks, make sure somebody has corporate development in the title. You put corporate development in somebody's title, people like me will be contacting you all the time with, you'll get some crazy stuff too, but with legitimate offers of companies that are for sale.
Yeah. So it's really figuring out how to get into the ecosystem and position yourself properly.
And we want to find you, but it drives me crazy because so many firms, so many big private equity firms that I won't mention, look, do your own research. You will see you can't contact them. They don't want to be contacted, or they'll put the big mugshot and the fancy bio of the founder and all these heavy-hitting people at the top, and then at the very bottom you might find somebody who is the actual person that you want to talk to. It should be flipped around, that the people make it easy for people like me to contact you if you want to buy a company. Get your contact information out there, follow up emails and phone calls, and it's just amazing to me how often. I mean, I spend most of my day deflecting people want to sell me fractional jet, bespoke suits, workout regimens. If I get one more jackwagon that says I'm just looking for X number of high-charging executives, it drives me crazy. But and it's the PE people. Hey, let's just talk about our list and our fabulous list of what's perfect for us. I might want to talk to that person. I don't have time in my day to do that. So make it easy for us to find you. When we have something that might be a fit, we will reach out and we'll be very happy to have that conversation.
Yeah. You mentioned a couple of different types of deals there. A private equity deal, a strategic. I guess, how do you categorize the types of exits for a company, or I guess give us the landscape of the types of exits that companies can have?
Sure. Well, the most important thing is that the owner of that company or owners of that company figure out what they want to do. Okay. Do they want to create some liquidity? Do they want to sell 70, 80% of the business, but hold on to a meaningful share, but they're going to be a minority owner, and then maybe work for, whatever, 2, 3, 4, 5 years, and then they want to get out? Well, if that's what they want, okay, fine. Then you better make sure that you understand how you're going to be able to sell those remaining shares. As let's say it's a private equity firm that buys you. Are they going to want to sell the company in a few years? Do you have some sort of put right that you can put those shares back into the company? You have to figure that out. Do you want to sell the whole thing and just retire completely? In which case, you want to make sure that company is set up right to operate without you, because a company that is not, where the owner is not needed, is going to be worth a lot more. And you want to communicate that. You're probably still going to be needed for some sort of transition period, 3 months, 6 months, maybe a year. It really depends. Do you want to sell, just create a little bit of liquidity, sell 30, 40% of the business? Well, then you have to find an investor, a buyer, private equity firm probably, that is okay with taking a minority position, but maybe put a plan together where there's some sort of formula where over the next X number of years, those remaining shares are going to be acquired. So whatever it is that the owner wants to do, that has to be communicated. There's no right or wrong, but they have to figure out what they want to do and then be able to communicate that to the buyers so it lines up with the buyer's expectations. Also, the business owners, make sure you talk to your tax people. This drives me crazy that sometimes they don't do this. Most often they don't. Why would they listen to me? I only sell companies for a living. Talk to your tax people ahead of time so you understand the structure that makes sense. Yeah, you're going to sell assets or you're going to sell equity. Everybody thinks that you have to sell equity. Maybe so, but maybe there is little to no difference if you can do an asset deal. And there might be some other wrinkles too. Your accounts receivable might be taxed at a higher rate than the rest of the proceeds because that's going to be viewed as cash, not a long-term capital gain. Talk to your tax people and have them do some calculations for you.
Yeah. So you mentioned before this whole, what does the owner, or what do the owners want to do? They want to get rid of, sell everything and retire or move on to something else. Take a minority stake, a majority stake. How do you figure that out? What does that conversation look like with a seller in terms of helping them sort through what type of deal they want to do?
Yeah, well, we'll ask the question just as you asked it, and then the answer usually is, I don't know. Whatever the buyer wants to do.
What are the options?
Well, no, and we're happy to talk about the options, but sometimes it's, and I'll say, look, we'll ask this question. Sometimes they know, right?
Yeah. Okay.
But if they don't, hey, don't make a quick decision. I can send you an email following up, talking about our conversation. Here are some things that you need to think about, and maybe it's just a matter of having that reflective time. Whatever you do to think, you take a walk with the dog, you drive your car, whatever, you go work out, you just sit in your chair and think. Whatever it is that you do to think, you need to do that. Maybe talk with the spouse, talk with your partners, in terms of what you want to do, because there is no right or wrong. The important thing is to have a plan when we go to market. Now, we can be open to taking different ideas. Maybe someone wants to sell all the company, and a buyer comes back and says, we'd like you to stick around for 5 years, and here's a different structure. Well, maybe we can consider it. Maybe we'll do that. But you have to have a specific plan. Why? I buy companies too. So I'm the guy who writes those offers, okay? And so when a seller says to me, I'll do whatever, how do I write that offer? Right? If they tell me, Bill, I want to sell the whole thing, okay, we can buy the whole thing. Bill, I want to sell a little bit and work for another 4 or 5 years. Okay, I can start putting that together. So you have to have something specific. You have to be very clear with what you want, because the market responds to clarity.
Yeah, yeah. So I want to ask a little bit about this, the big one that everyone talks about, which is I want to sell my company. Like, how much am I going to get? Like, how do you approach the whole valuation conversation with sellers in terms of, helping them understand the nature of their business, what the market is looking for, how they value these things, kind of the things that affect valuation, or maybe the different types of deals that will kind of have different valuations? Like, what does that conversation look like?
Well, yeah, a couple things. Is the person working with a financial planner? Do you have a number that you need to hit? Okay. And it's nice to hear that. Okay, and then we can look at the business and think, yeah, I think we have a good chance after taxes are paid that that number or more will be met. Or if it's type of thing where I need to have 100 million, and well, let's hear after tax, I think you're going to get about 2 million.
Yeah.
That's a hole nobody can fill. So it's nice to know that ahead of time. M&A is microeconomic. Everybody thinks it's macro. Everybody's looking at what's going on in the economy as if that's going to, a strong economy is going to help a bad company. It won't, okay? A good company in a bad economy will command a good price, probably a premium, because finding good assets is difficult. A bad company, revenues are dropping, it's losing money, key managers are fleeing the company. It has a big concentration maybe with a customer. Bad company, struggling company, but the economy is great. I don't care how great the economy is. That bad company is going to get low bids, maybe struggle to find bids. The macro can certainly impact the micro, but as long as the company at the micro level is performing well, I don't care what the economy is. And so I think it's a bit of a misnomer. Let's try and time it. When's the market going to be hot? Who the heck knows? Control what you can control. Do the things that you can do to improve the value of the business. Because M&A, like I said, is microeconomic. It's supply side. You put the supply out there. It's not demand driven. Okay, the demand's out there. You put supply out there, you will get offers. You might not like the offers, but if you get 3, 4, 5 offers, and quite often you'll see a trading band, that they're pretty close in price. You might not like it, but what does that tell you? That's how the market values the business. So we tell them that. We can do all kinds of valuation exercises, which I think are good to some extent, but that's an academic exercise.
Yeah.
What we want to find, and I can't guarantee it, sometimes it's there, sometimes not, we want to find that buyer with a strategic imperative, right? That buyer that absolutely needs to do the acquisition for reasons beyond the profitability that they're buying. It's plugging a hole in the product offering.
Give us some examples of that, because I think that's the interesting one. I think everyone's familiar with that private equity comes in, they look at the numbers, they'll give you 5 to 8, right? Like the financial. The strategics are where it gets really fascinating. You see these kind of crazy situations of valuation and opportunities.
You do, and actually, because it's difficult to find good assets, demand is still there, but the good assets are not there as much. Quite often the private equity firms are just as competitive, maybe even more so than the strategics, because these private equity, big private equity behemoths, they've got all this money they've got to put to work.
Put things into play.
Yeah, and so we'll do all cash now and hope that we can refinance at some point in the future if interest rates come down. But I've lost the original question that you had.
How do you find the strategic, or how do you identify these strategic opportunities that are above and beyond just a financial calculation?
Yeah, so I'll give you some examples. So we sold a company a long time ago, and they made equipment that you saw in kitchens, professional kitchens and stores and things like that. And the buyer had been chasing this company for a number of years. And our client was located in more of the central part of the country in Louisville. The buyer had a facility, was backed by a PE firm, and they were on Long Island, New York. So they had a old, decrepit facility, and they're distributing to the United States from Long Island. I mean, no offense to Long Island, it's great there, but that just doesn't make any sense. Right?
It's just cross at least 2 bridges to get anywhere.
Just doesn't make any sense.
Yeah.
So they were looking at spending millions of dollars to build a new facility, and lo and behold, they can get this company that they've been chasing. So they were willing to pay a price far beyond anybody else. Of course, when I talked to them, I said, you pay they paid the exact right price, $1 less than my client would have walked, but they were the highest bidder. And the reason that they paid that much is because they were willing to spend millions of dollars to buy or somehow obtain a new facility. So they were able to roll what they were willing to pay for a facility into this company because my client was located in the Midwest, in Louisville, close to the Midwest, I guess. And they had a state-of-the-art facility that was underutilized.
Yeah.
Okay, underutilized. So the buyer could roll that facility from Long Island into Louisville, save all kinds of money. It was worth every penny. So that is something that shows up in terms of a strategic imperative. We had another situation. We were selling a company, smaller company, it was a packaging company, and they had a fantastic system, inventory system, an accounting system. Their controller could have been a CFO in a Fortune 500 company. She just didn't want that lifestyle, had kids at home, just wanted to work, part-time, like 3/4 time. So they had the benefit of a really sharp woman who could have been, like I said, a C-suite executive in a big company, didn't want that, so they got that benefit. They had another partner there who was great with technology. And when we had the first meeting with the company that was the ultimate buyer, the first thing the president of the buyer said is, our accounting system is all blanked up. He used a word that we can't use in a polite company here. And I thought, hot dog, this is going to be our buyer, because it's just not the product, it's just not the profitability, which was very nice, but our client solves a problem for the buyer. So quite often it's boring stuff like that, systems, warehouses, things like that can add real value in the right situation.
How do you, like when you're looking at a seller, like how do you kind of assess where those opportunities are? Like what kind of capabilities or assets, and like is there a process that you go through to sort of see, hey, there may be some things here we could create strategic value around?
The process, it's a very unusual thing that the younger people are probably not familiar with. We will talk to them. We won't send emails. We'll have a phone conversation. Sometimes this is going to be a shock to people. They better sit down. We will sit down in the same room and have a conversation. And it's amazing when you learn about their business and you ask intelligent questions. What comes out. It's just, I really recommend it. Get out of your rooms, everybody, as I'm sitting here in my office at home, of course. Get out. Don't be like me, okay?
Yeah.
Go get out there.
Do as I say, not as I do.
Yeah, pick up the phone. It's just amazing. Stop using emails and texting and all this stuff that they're doing. But we'll have a conversation. We want to learn about their business. Yeah. And what we're looking for is 4, 5, 6 situations or aspects of the business that might add value, and you don't know. Sometimes you have an idea or a sense of it, but you don't know till you have that conversation. And so going back to that client years ago when they talked about and we saw it firsthand, just the reporting they did and their inventory system, how well that was managed, that was one of the key selling points. Yeah, it's a nice business, the profitability is this and that, but they also have this wonderful system and inventory management and so forth. There were some other value adds. So sometimes you can identify those things. Sometimes when you're talking, you have to see what the buyers are coming back with in terms of what is motivating them. So sometimes we're surprised, and sometimes it's the things that we're expecting. Like I say, I can't guarantee that strategic imperative is out there, but quite often it is. And if we talk to that right buyer who has that strategic imperative, they will bid accordingly. And quite often you'll see maybe 3, 4, 5 offers here, and then you have that one offer up here that's clearly above the trading band. Why? Because they're willing to pay more, because they need this business for reasons beyond the financial performance of the company.
Yeah, exactly. Talk to us about a little bit about how the general process works, or idealize. I'm sure that no client goes through the perfect process, but like when you start talking to a buyer, like how do you kind of set their expectations in terms of phases, time frames? How long is this going to take? What are the things they need to kind of do? Map this out for us.
Sure. You talk to the seller. You mean when they're looking to sell the business?
When a seller, hey, I'm interested in selling. Like, okay, do I do it this week? Does it take 6 years? Like, how do you kind of set their expectations in terms of time?
It takes 6 years, sure. No, once we're going, it should take roughly 9 months, give or take. Okay, and so the steps are, we get signed up to do whatever, sell the company or sell part of the company. We'll put materials together. We'll put a deal book together. It's called a Confidential Information Memorandum, SIM. We love acronyms in this business, right? EBITDA is an acronym, right? M&A is an acronym, LOI is an acronym. We love acronyms. So we'll put the SIM together, the deal book together. At the same time, we'll put a buyer's list together. Quite often, the business owner has been contacted by numerous potential buyers. Maybe he has a short list of some competitors or some other companies that might be interested. So we can use that list of 4, 5, 10, whatever, and build out, do research with Capital IQ, which is what I mentioned. So if you're a buyer, make sure we can find you on Capital IQ. You will get opportunities. Make sure you put corporate development in your title.
Exactly.
I don't care about anything else. Corporate development, that's what I want to talk to. So we'll put that buyer's list together. The seller will approve every buyer on that list. And typically we'll start with a bigger list and we'll winnow that down. Maybe we'll put some crazy things in there. We'll cast a wide net, but I want to get that down to maybe somewhere around 100, 120, something like that. Then we will reach out to those buyers. And that's phone calls, that's email. The first dummies book that I wrote, I called that The Alchemy of Phone Call and Email. And one of the editors came back and said, we can't use that. I said, why not? And I kid you not. The concern was that we would insult the alchemists of the world. And they didn't realize the joke. And I said, I'll take my chance with the Alchemist Guild. I have not been sued by the Alchemist Guild yet. It's been 13 years, so we'll reach out to the buyers. We'll send a teaser, which does not name the company, but provides some financial information, obviously what the company does. We'll have a non-disclosure agreement or confidentiality agreement, we call it CA. Again, we love the acronyms. If the buyer's interested, they sign the CA, and when we get that CA signed, then we send the deal book off, the SIM. Again, we love acronyms. The buyer, the first thing that they do is they come back to us with an indication of interest in IOI. God, we love acronyms. And that indication of interest is, we're interested, and here's kind of some rough ideas of the deal structure. And the big thing we're looking for is the valuation range. Okay, and based on that valuation range, we will have meetings with hopefully 5, 6, 7 potential buyers who we think are serious, and their offers are meet the expectation of the seller. After those management meetings, we ask the buyers to come back with a letter of intent, LOI. That's going to have a lot more detail in terms of the timing and the structure. We'll have a specific price, not just a range anymore, and some other details. We'll do some negotiating most likely, sign an LOI, go to due diligence and purchase agreement writing, and then you close the transaction. All told, should take roughly 9 months. Everybody thinks they can get it done faster. I just don't know where you can trim substantial amounts of time, because we have to get a lot of information from the client. They have a business to run, and quite often that's the big slowdown. No fault of the client. They've got a business to run, but we can't do our work till we get the materials. But it should take roughly 9 months.
Yeah, and where if a process breaks down, where does it typically break down for you?
The company is not performing. Is the big thing. So we've had this before where it had a great year, and then now we're going through our process, starting to put the materials together, and we're getting month after month of financials of, wow, now you're losing money. That's not good. We're eating away at the trailing 12 EBITDA, right? We're going to look at the last 12 is what buyers typically do. So we're seeing erosion there. We're not seeing any a pickup. Well, hey, maybe we need to put this thing on hiatus. So we've had that before. So that's the big one. Or the company, I had another client where everything that could go wrong went wrong. They had a substantial drop all of a sudden in profitability. EPA showed up and said you're doing something wrong. So now you got an EPA problem. You have to fix that. And there was a lawsuit by a former partner. So everything that could go wrong went wrong, and pulled the plug on that. That's been a few years, and maybe at some point we'll sell that. But if the company is performing well, and growing, profits are growing ideally, you're going to get offers. You're probably going to get multiple offers. And then the only question is, are the offers what the market is saying? Does that meet the expectation of the seller?
In our prep conversation here, you mentioned that most of the sellers, once they get through this process, they tell you they wish they knew all about this far sooner. What are some of the things that sellers can be thinking about earlier in the process, and when should they start thinking about some of these things so that they have a more successful sale?
Sure. The biggest thing is, owner, make thyself expendable. A company is going to be worth more if you, the owner, are not needed. And that's a bitter pill for a lot of business owners to swallow. So make sure other people are running the business day to day. The business will be worth more. make sure if you have concentrations. Okay, so if one of your customers accounts for a substantial amount, 40, 50% of sales, or if it's 80, 90% we've seen at times, that's something that is going to diminish the value of the business, because if that one customer that is 40, 50% of your business fires you, your business is impacted. So that's a huge amount of risk. So maybe that takes multiple years. Try and spread out that risk by getting additional clients for that big client, which is great to have. That big client is not such a big client in terms of the percent of the business. Pay attention to the balance sheet. Okay, one of the things that it gets really boring in M&A, you're going to do these things called working capital adjustments. Okay, so you want to understand what is working capital, which is essentially going to be accounts receivable plus inventory minus accounts payable. Okay, so are you collecting your AR on time? Mm-hmm. If you are writing off AR, or if you have huge amounts of dollars that have been in AR for 180 days, certainly over 90 days. Yeah. Are you really going to collect this? A buyer's going to say, "Wait a minute, is this impacted?" Yeah. I mean, if it's $5,000, who cares? But if it's a substantial amount of money, that's going to be a problem. What is the history of writing off that bad debt? Inventory. Are you writing off bad inventory? And here's where this comes in. This gets really boring, because what you want to do if you have a company with inventory is you're going to take a measurement. You should be taking a measurement, hopefully by auditors or reviewers, on January 1st and then also on December 31st. And then you're going to look at what was bought, what was sold. And this way you can calculate very accurately cost of goods sold. And if that is accurate, guess what? That flows right down to the bottom line. If we don't know what the actual cost of goods sold are, in other words, maybe the auditors were not there on January 1st because it's the first year of an audit, okay, we'll take a deeper look, but that might be an issue. Okay, and especially if inventory is obsolete, it's slow moving, things like that. A buyer might say, "You know what, this is impacted. You're not going to sell it. I want this written off." And what a lot of people say is, "Okay, fine. You're going to reduce my assets, my inventory by $500,000. Big deal." Well, it's not just that, because that hits the earnings, and so you have to look at the multiple. So if it's a 5 multiple, that's a $2.5 million hit. If it's a 7 multiple, that's a $3.5 million hit. So it's just not $500,000 off. It's reducing your earnings. So pay close attention to that. Payables, as a lot of times companies want to pay very quickly on time. You know what? If you got 30 days, take 30 days, because that's a use of your cash. And as odd as that might sound, that can come back and ding you at the end, because the buyer might say, "We're not going to pay as quickly. We're going to take the 30 days or 45 days and then pay." And so that can they have to have a readjustment in terms of that working capital amount, and that can hurt you. So talk to your accountants, what they recommend, how to help you prepare the business to be able to sell.
Yeah, and it's easier to do it when you've got some time to make those adjustments before you actually go into the sales process. You're trying to do all this 30 days before you're going into sales. It's not. It ain't going to happen.
It's the same thing. We get contacted all the time by all kinds of well-meaning consultants who want to have us do all the work of obtaining the client and then turn it over to them, because I've got this great sales thing. I'll improve the sales and do this and blah 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 blah, and make the company worth a lot more, and then you'll get more bill. And how long does that take? Can you get that done in a week or two? No, we need a couple of years. Okay, goodbye. That's that's
not our time frame.
It might be valuable, but it's not going to do any good for us, because we get retained. I want to start working as soon as possible. I want to get the thing done and closed as soon as possible. I don't want to sit around and wait for a few years. Okay?
Yeah, I got it.
Because the client's not going to do that.
So for an owner who's looking to sell, like, who should they involve in this process? Because I think it's a big kind of decision or kind of challenge for a lot of folks. I've got a lot of people on my leadership team or the people in the company that know all these things or that have insights in this stuff. I guess, how do you advise, or what do you advise owner-sellers to do in terms of who they should involve in the sales process and preparation for sale?
Sure. When they're ready to go, hire an investment banker. Absolutely. Okay. And there, talk to a couple different people, a couple different firms. The first thing you want to look at is hire somebody you like. Okay. If you don't like the person for whatever reason, don't hire them. Okay. You want to look at their history and what they've done. And the most important thing is the ability to negotiate. You want to determine that. And what I always say is get their fee agreements, cut them to the bone, And if the investment banker takes your lowball offer, don't hire them, because the way that that investment banker negotiates with you is how that investment banker will negotiate for you. Okay, that's very important. You want to have a lawyer. Big mistake that we see is a business owner who's selling the business hires or maybe is using an attorney that he or she's been using for years to do contracts and some other things, but has not done transactional work. You want an M&A attorney. You want somebody who has done transactions in the past. Very important. We had a situation years ago where the owner refused to hire somebody with M&A experience. I'll use I think it was a roommate. I've known the guy 40 years, and it was a capable attorney. You know, do some contracts, and the daughter gets a DUI and gets you out and helps you adopt a kid from China and all that kind of stuff. Very valid legal stuff, right? But you have not done M&A work. And how did that ding us? Okay, the other guys were working it, because I would never let something like that happen. But what happened is, when the deal was moving to the purchase agreement writing and due diligence phase, you're going to be leaning on the lawyers. And one of the things that goes on is the production of schedules, all kinds of documents that back up all the promises that are made in the purchase agreement. That is brain damage work, trying to get that. You don't want a senior person billing out at a senior rate doing that work. You want young people who don't know any better to do that. So you want paralegals and junior accountants who are trying to make their mark, and they're willing to work late, and they don't bill as much. But you have also multiple bodies working on this. And so this lawyer was just in an office by himself doing good legal work, but he didn't have a support team. And so what happened is the deal was supposed to close in January. The lawyer couldn't get the schedules done. Well, now we're closing in February. The lawyer still couldn't get the schedules done because he didn't realize how much work goes on these things, because he's never done one of these transactions. Early March, the big customer of the client fired the client, and they lost, 30% of their business. And guess what? The buyer said, hold on, we're pulling up stakes. And it took years before a transaction got done. Why? Because the lawyer was not prepared. So you think you're doing a favor to an old pal who's an attorney. You think it's going to be done economically. It can cost you. Hire a firm, a larger firm that has suitable people, support people for that M&A attorney. It'll be worth every penny.
Yeah, well said. Bill, this has been a pleasure. If people want to find out more about you, more about the work that you're doing, what's the best way to get that information?
You can go to the website that I will have until the day I die, and then I'll pass that along to some heirs, and then they'll keep a memorial for me in perpetuity. That's BillSnow.com. Not Bill's Now, that's BillSnow.com. You can also find me at FocusBankers.com, Focus Investment Banking. So we are an investment banking firm. We do nothing with investments. We're not a bank. But we call ourselves investment bankers. So we work with middle market, lower middle market companies and help them buy companies, help them sell, things like that.
Perfect. I'll make sure the notes are in the show, the information's in the show notes so people can get that. Bill, thank you so much for taking the time today. It's been a pleasure.
My pleasure. Thank you.